Welcome to the Allen Resources video seminar series. My name is Fernando Diaz and I teach finance at the Martin J. Whitman School of Management at Syracuse University. Today we'll be covering asset valuation, specifically derivative investments at the level 1. So let's start right away. Let's first define what a derivative security is, and let us say a derivative security is a financial contract whose value and returns depends or also derives from the value and returns of some other asset, which we shall call the underlying asset. This underlying asset is important because that's what defines what the derivative is written on. Now, where do these instruments or financial contracts trade? Let's look at that. Derivative securities trade in two specific markets. One is the exchanges and centralized markets, and for example, some of them are the Chicago Mercantile Exchange, the Chicago Board of Options Exchange, the Chicago Board of Trade, etc. For example, we have the S&P 500 futures contract traded at the Chicago Mercantile Exchange, I'd say the S&P 100 index option trading at the Chicago Board of Trade, and let's say we have the Treasury bond futures contract trading at the Chicago Board of Trade. Derivatives are also traded in OTC or over-the-counter markets, and in these markets we have three or two, and if you combine these two, we have a third participant. We have brokers, we have dealers, and we have broker-dealers. And the brokers are simply middlemen who earn a living by putting the counterparties of a deal together and charging a commission and or the bid-ask spread on the deal. Dealers work similarly to brokers, but they hold inventory of the security or contract that is being traded, so they can become a counterparty. And then we have broker-dealers that serve both functions. So in summary, derivative securities trade in two types of markets: exchanges, centralized exchanges, and the over-the-counter market. Let's now differentiate let's talk about the differences between the exchange-traded markets and the over-the-counter markets. The exchange-traded markets, the characteristics of derivatives that trade in exchanges is that derivative contracts are highly standardized, have highly standardized contract specifications. In them, usually gains or losses are settled on a daily basis, and that is called mark-to-market. So in exchanges, often gains or losses due to derivative trading is settled on a daily basis, and that is called mark-to-market or daily settlement. Another characteristic of exchange-traded derivatives is that the counterparty of choice is the clearing house. The clearing house is the counterparty to all transactions, thus reducing credit risk substantially because the clearing house is a highly capitalized counterparty. And finally, exchanges are highly regulated entities that protect the integrity of markets and investors. Let's now compare that to over-the-counter markets. In over-the-counter markets, on the other hand, the derivatives or the contract specification of derivatives traded in these markets is highly customized. In other words, here the terms of the derivative contracts tend to be customized to the needs of the counterparties involved. As a result, no clearinghouse exists in over-the-counter market because counterparties deal directly with each other. The over-the-counter market is also a self-regulating market, not regulated like exchanges. For example, futures exchanges are regulated by the CFTC, a Commodity Futures Trading Commission, the National Futures Association, and also members of the exchange. In the case of over-the-counter markets, those are self-regulating. And the fourth difference is that credit risk of counterparties becomes an important consideration when entering a transaction in these markets because you're dealing directly with your counterparty, and counterparty risk is a serious consideration in these markets. Let's now define the general or the generic type of derivatives. We have, on the one hand, forward commitments, and let's define what a forward commitment is. A forward commitment is an agreement between two counterparties. In the case of an exchange-traded derivative, it could be between you and the clearinghouse. In an over-the-counter market, it could be between a bank and another bank, or a bank and a corporation. So those are the two counterparties. To buy or sell, buy and sell an asset in the future at a given price. And this price has a specific name depending on the derivative we're dealing with. And examples of these forward commitments are, specific examples of these forward commitments are forward contracts, futures contracts, and swap contracts. These three are forward commitments or forward obligations. So I guess when we talk about commitments, we really mean obligations. Both counterparties are obligated under the contract to either buy or sell, take delivery or make delivery of the underlying asset at a future date by paying and getting paid the agreed upon price in the contract. Let's then talk about one of these forward commitments, the forward contract. A forward contract is a forward commitment that is created in an over-the-counter market. Let me give you an example of a forward contract, and that is a forward contract to buy electricity at a future time. So the underlying asset in this case is electricity. The specific or fixed price at which I or a utility will buy this electricity is called the forward price. These contracts are highly customized. Remember, they trade in an over-the-counter market. There's no clearinghouse. In the case of the electricity forward contract, the counterparties would likely be a generating company and a utility. The generating company on the selling side and the utility on the buying side of the contract. There's no mark-to-market activity. In other words, these contracts, these forward contracts on electricity are not settled, or gains or losses are not accrued to each counterparty's account on a daily basis. Gains or losses are accrued to each counterparty only at settlement time, which takes place at the expiration of this contract. Counterparties deal with each other. As I said before, in this case, or in this example, the counterparties would be a generator or generating company and a utility. They deal directly with each other, oftentimes put together by a broker, who will charge a commission and or a bid-ask spread on this transaction as their source of revenue. And finally, oftentimes, there is no secondary market for these over-the-counter forward contracts. And by secondary market, we mean a market for the resale of an existing contract. And so if one of the counterparties wants to get out, it has to negotiate with the other counterparty a way out, or it can enter what we'll call later an offsetting forward contract. So a forward contract is an example of one of the forward commitments we saw, and remember, it is traded in the over-the-counter market. Let's now look at another forward commitment, which is called the futures contract. The futures contract is a forward commitment, but it's created and traded in a futures exchange. Unlike the forward contract, futures can only trade on an exchange. It is illegal for a futures contract to trade off exchange. Now, what is the difference between a futures contract and the forward contract, or what are the characteristics of this futures contract? Let's take, for example, the crude oil futures contract. It's highly standardized. So, for example, the standard size of a futures contract on crude oil traded at the New York Mercantile Exchange, that's the exchange, is that the quantity of crude oil traded is about 1,000 barrels. Not a barrel more, not a barrel less. That's the standard size of the contract. How does the price of crude oil, how is it quoted? It is quoted on a dollar per barrel basis.